Most people think a taxable brokerage account is just a retirement account without the rules. That misunderstanding has cost people a fortune, because the taxable brokerage is not merely a spare account. It is a test of whether you really understand what it means to be an owner, a test of whether you understand taxes well enough to respect them, a test of whether you can choose the right assets when no employer is forcing the structure for you, a test of whether you can resist the temptation to chase what looks exciting instead of what actually works, and above all, a test of whether you know the difference between having another account and having another plan. That is where I would begin, not with 5 ticker symbols, not with a neat little pie chart, not with a sentence like just buy these and hold forever, as though the account itself will do the thinking for you. I would begin by telling the truth. A taxable brokerage account can become one of the most powerful wealth building tools in your life. It can also become a very expensive playground for people who do not understand what belongs there and what does not. That is the whole issue. And if you are serious about building wealth in that account, then you must stop thinking like a shopper and start thinking like an allocator of capital. That is Buffett language. That is how I would frame it. Because the first mistake people make with a taxable brokerage is assuming the rules are basically the same as a 401k or IRA. They are not. The word taxable is not decoration. It is the central fact. Inside a 401k, an ERA, or especially a Roth IRA, the taxes are deferred or eliminated in ways that give you enormous freedom to be somewhat imperfect. You can trade without immediate tax recognition. You can hold bonds without ordinary income leakage hurting you every year in the same visible way. You can let dividends roll without the same annual irritation. You can be wrong without paying the taxman every time you breathe on the portfolio. In a taxable brokerage, it is different. Every sale can matter. Every distribution can matter. Every ordinary dividend versus qualified dividend distinction can matter. Every little structural choice can create a drag. You do not feel immediately, but absolutely feel over a decade. Fay file a site Fay turn 31 file 0 Fay. That is why so many people who think they are investing sensibly are quietly building a weaker portfolio than they needed to. Now let me say something even plainer. That taxable brokerage is not a place for sloppy income fantasies. It is not where I would put assets that throw off ugly, tax inefficient income if there were a better home for them. It is not where I would casually drop high-yield products just because the yield looked delicious in the thumbnail. It is not where I would put something that creates unnecessary ordinary income tax friction if I had an IRA or 401k available for it instead. That is why I smiled when I saw your source file mention JEPQ. It is exactly the kind of product many people think belongs in taxable because the headline yield looks wonderful, almost 10% monthly cash. The emotional appeal is obvious. The tax reality is uglier. Much of that distribution is taxed as ordinary income rather than as qualified dividends, which means a high earner can get hit at far less attractive rates. That is not intelligent account placement. That is yield chasing without respecting the structure. The file says this very clearly. JEPQ is generally inefficient for taxable accounts and fits much better in tax advantage space. Fay file site Fay turn 31 file 0 Fay. This is one reason I distrust the way people talk about dividend investing. They fall in love with the visible cash and forget to ask what kind of cash it is, where it belongs, what tax treatment it receives, and whether the account itself is the right vessel for that strategy. That is not analysis. That is appetite. I prefer analysis. So the first rule of a taxable brokerage account is not find the hottest ETF. The first rule is respect taxes. That means understanding the difference between qualified and non-qualified dividends. That means understanding capital gains consequences when you sell. That means understanding that reinvesting a dividend does not make the tax event disappear. That means understanding that where you hold an asset can matter nearly as much as whether you hold it at all. I know that sounds less exciting than a top 5 list. It is also more profitable. Now, once that foundation is clear, then we can talk about what belongs inside a buy and hold taxable portfolio. The source material breaks the portfolio into categories, and I think that is exactly the right way to think. Not because a portfolio must be complicated, quite the opposite. Categories keep a person from confusing one job with another. A strong taxable brokerage portfolio is not a bag of symbols. It is a set of jobs being done by the right tools. One job is foundational market ownership. One job is tax-aware value or dividend exposure. One job is international diversification. One job is broad growth. And then, if the investor has the stomach, one smaller sleeve can be reserved for more aggressive growth. That is not random, that is architecture. And architecture matters. Let us start with the part people most often overcomplicate, even though it should be the simplest, the foundation. If I could only teach one habit to ordinary investors, it would be this: own a broad slice of the American productive machine and keep owning it through fear, boredom, politics, headlines, crashes, and all the other little dramas that never stop. The source material gives the perfect historical reminder. $100 invested in the S&P 500 right before the Great Depression, with dividends reinvested, becomes an extraordinary sum by 2026 despite the depression, wars, inflation, recessions, the dot-com crash, the financial crisis, and COVID. That is not a fairy tale. It is the reward for owning productive businesses over time and refusing to let temporary horror override structural truth. Fay Filicite, Fay Turn 31 File 0 Fay. That is why a foundational ETF matters so much. VO if you want the S&P 500, VTI if you want the total U.S. stock market. They are not identical, but they are close enough in spirit that the more important question is not which one wins the argument in a comment section. The more important question is whether you will actually hold the thing long enough for compounding to matter. I do not lose sleep over whether an ordinary investor chooses VO or VTI. I lose sleep over whether he chooses neither because he was waiting for perfect certainty. The file handles this sensibly. VTI gives you thousands of U.S. companies. VOU gives you the 500 giants. Long term, the results are close. Fees are low. The right answer is often the one you will actually keep funding and keep holding. Fay Filicite, Fay Turn 31, File 0 Fay. Now let us come to the second job: tax, aware value, and dividend exposure. I understand why people like dividends. Cash flow feels real, it feels tangible, it feels like the portfolio is working. But in taxable, the wrong dividend exposure can create annual friction that eats more than people realize. So the question is not, should I get dividends? The question is, which dividend exposure behaves intelligently in this account? That is why the source file pushes toward funds like SAG, VIM, or even VTV, depending on the balance between yield, value exposure, and tax sensitivity. CHD gives stronger dividend cash flow. VTV may create less taxable dividend burden while still giving you a value tilt. That is the kind of nuance I like because it is built around the account, not just the asset. Fay Filicite, Fay Turn 31, File 0 Fay, and I want to underline what the file says about the purpose of this category because it is easy to miss. This slice of the portfolio is not only about dividends, it is also about temperament. The businesses inside these kinds of funds tend to be sturdier, lower volatility, less dependent on high growth fantasy, and often more resilient when the market gets ugly. In other words, this sleeve is helping not only the mathematics of the portfolio, but the psychology of the investor that matters. If a certain structure helps you stay invested, then that structure has value beyond the spreadsheet. Now, let us talk about cash for a moment, because people are always strangely confused about where to park it inside taxable. The source material makes a reasonable point. Money markets are fine. SCOV is also compelling, especially for certain investors, because of the state tax angle and current yield. That is a practical, context-dependent decision, and I appreciate that. Too many people want one universal answer when the real answer depends on tax bracket, state, and purpose of cash. What matters is that the cash bucket remain liquid, boring, and not confused with long-term investing capital. Cash has one job: optionality. It should not be expected to carry the emotional burden of being both safe and a serious long-run compounder. Fay Filicite, Fay Turn 31 File 0 Fay, the same section in your file says something I strongly agree with. Traditional bonds and bond ETFs are generally poor residents of taxable brokerage accounts. If you have better tax advantage space available, why? Because bond income is typically taxed as ordinary income. Again, this comes back to respecting the account. If an asset throws off ordinary income and you can place it in a sheltered account instead, why would you volunteer to drag it through taxable space unless you had a specific reason? That is not cleverness. That is leakage. Fay Filicite, Fay Turn 31 File 0 Fay. Now we move to the third job: international diversification. This is where people become ideological for no good reason. Some say ignore international entirely because the U.S. is dominated. Others say you need massive international exposure because otherwise you are not truly diversified. I find both attitudes tiresome. The source file takes the more adult position, own some international for diversification, but do not become sentimental about its long-term return profile. VEXUS gives you broad non-use exposure, thousands of companies, and a hedge against pure domestic concentration. But the file is equally clear that long-term international returns have generally lagged the U.S. broad market, even if there are periods where international leads. That is the kind of sober framing I trust. Fay file site Fay turn 31 file 0 Fay. So how do I interpret that international should usually be a supporting actor in a taxable brokerage portfolio, not the star enough to diversify, not so much that you are pretending the long run. Record says something it does not. That is why a lower allocation here often makes sense for many U.S.-based investors. Diversification is good. Over-romanticizing lagging assets is not. Then we come to the fourth job, broad growth. This is where many investors either become too timid or too reckless. They are either so frightened of volatility that they own the very part of the market that has driven much of long-run outperformance, or they become so intoxicated by growth that they concentrate their future into one narrow theme and call it conviction. I prefer something in between, a broad growth ETF that still gives you diversification, still gives you access to the innovative winners, but does not reduce the whole portfolio to one narrow bet. The source file names QQQM, South Carolina, HG, VUG, and ESMO as examples. I understand why. These are not tiny speculative plays. They are broad enough to matter and aggressive enough to move the needle. The NASDAQ 100, especially through QQQM, has had extraordinary long-run results, though not without volatility. That is the whole trade. More firepower, more drama. The investor must know whether his temperament matches the vehicle. Fay site Fay turn 31 file 0 Fay. This is one reason I like having categories. It lets you say, this is my foundation. This is my value and dividend stabilizer. This is my international diversifier. And this is my growth engine. Each part has a role. Once roles are assigned, behavior improves. That brings us to the fifth job. And here I become much more cautious. Aggressive growth. This is where many people destroy perfectly good portfolios because they cannot resist the thrill of something specific. Semiconductors, Bitcoin, miners, metals, pure technology, a dazzling sector, a trend, a story, the source file names SMH, XME, IBIT, and VGT to show the difference between more concentrated upside and broader consistency. I think the file is fair about this. These funds can be powerful. They can also be brutally volatile sector. Specific success can feel genius on the way up and sickening on the way down. That is why, if they exist in the portfolio at all, they should usually be smaller sleeves, optional, not foundational. Fay file site Fay turn 31 file 0 Fay. And if an investor does not know whether he should own this sleeve, that is usually a sign he does not need it yet. There is a line I have lived by for years. You do not build lasting wealth by needing every part of the portfolio to be exciting. In fact, excitement is often the enemy. Now let us talk about percentages, because this is where generic videos become dangerous. People love the simplicity of 5 tickers, but the weights are where lives diverge. Wrong weightings can do more damage than a wrong ticker. The source file is correct to emphasize this. A 30-year old with high risk tolerance and long runway can hold more growth than a little aggressive growth. A midlife investor with higher earnings and greater tax sensitivity may want more value, still strong growth and a moderate international slice. A near retiree may want more JEPQ-style cash flow and stability, less aggressive growth, and a much gentler balance overall. Fay site Fay turn 31 file 0 Fay that is not inconsistency. That is adulthood. The portfolio should reflect not just what assets are good in some abstract sense, but what job the money is doing and who the owner has become. If you are 30, the taxable brokerage is probably a second or third bucket alongside retirement accounts. That means it can afford to carry more growth. It can be a companion to a 401k, not your entire life raft. The source file S-high risk example reflects that. More VU, more QQQM, some SAG, a touch of VXs. A measured sleeve of aggressive growth like VGT, I think that is reasonable for the right temperament. Let's put aside Fay turn 31 file 0 Fay if you are in your 40s or 50s. The taxable brokerage becomes more nuanced. Taxes matter more because you are usually in stronger earning years. You may want to retire early. You may need accessible money before age-based retirement rules open the main gates. In that case, the account must do two jobs at once: grow and stay usable. That is why the file tilts that sample portfolio toward VTV in the value sleeve, keeps VO at the core, adds some VXs, keeps broad growth via CG, and limits aggressive growth to a smaller portion like VGT. That is not random. That is account. Role thinking, Fay Felicite, Fay turn 31, file 0 Fay, if you are nearing retirement. The taxable brokerage becomes even more about temperament, usable cash flow, and avoiding self-inflicted chaos. More Shiji, some boxes, a modest broad growth sleeve. No need to prove courage through aggressive sectors if the emotional and financial consequences of a deep drawdown would be severe. That too is maturity. Fay file site, Fay turn 31, file 0 Fay, and let me make one thing absolutely clear. All of these taxable brokerage examples only make sense if the investor also has the obvious basics in place. An emergency fund retirement accounts being used where available, no catastrophic short-term cash needs being disguised as long-term investment money, a willingness to hold through ordinary volatility. The taxable brokerage is a powerful tool. It is not a replacement for structural sanity. Now, I want to come back to the original video title idea you gave me, because Best ETFs for Taxable Brokerage 2026 is the sort of title that attracts the right audience and the wrong expectation. It attracts people who want clarity. Good, but it also attracts people who secretly want permission not to think. They want 5 symbols and the illusion that the work is done. I would rather give them something stronger. The best ETF portfolio for a taxable brokerage account is not just a list. It is a set of rules. Rule 1. Respect taxes more than excitement. Rule 2. Put tax inefficient income assets elsewhere when possible. Rule 3. Make the foundation boring and broad. Rule 4. Use dividend and value exposure intelligently, not sentimentally. Rule 5. Diversify internationally, but do not worship it. Rule 6. Let growth have a job, but do not let it become your identity. Rule 7. Keep aggressive thematic exposure small enough that it cannot ruin you. Rule 8. Match the percentages to your age, tax reality, and goal. Rule 9. Do not use a taxable brokerage as a casino just because it is accessible. Rule 10. Hold long enough for the structure to matter. That is how I would teach it around a kitchen table. Not because slogans help, because rules survive mood. And mood is what destroys most taxable accounts. Someone opens one with good intentions. Then they get impatient. They see yield and want more yield. They see QQM and want only QQQM. They see semiconductors scream higher and decide diversification is for cowards. They see Bitcoin move and decide structure is boring. They panic in a downturn and create taxes for the privilege of feeling safe for an afternoon. Then they call the market unfair. Number, they were undisciplined. The taxable brokerage account is one of the greatest mirrors of character in the whole investing world. It reveals whether you can think like an owner when nobody is forcing you to. That is why I care about it. Because if you can master this account, you usually have learned some of the most important lessons in all of investing. Patience, tax awareness, asset location, diversification, age, appropriate aggression, respect for fees, respect for income character, and a refusal to confuse accessibility with permission to be sloppy. That is a lot of wisdom in one simple looking account. So if I were building a taxable brokerage account in 2026 and I wanted something I could hold forever, I would not ask for the hottest 5 ETFs. I would ask for a portfolio that understands the account. A portfolio that knows why JEPQ is seductive but misplaced here. A portfolio that knows why bond ETFs usually belong elsewhere if possible. A portfolio that knows why VU or VTI must anchor the center. A portfolio that uses SEG, VIM, or VTV with a tax. Our purpose, a portfolio that lets Vexus diversify without pretending it deserves the throne. A portfolio that adds QQQM, South Carolina HG VUG, or something similar for broader growth. A portfolio that treats VGT, SMH, EPIT, XME, and their cousins as optional spice, not the meal. A portfolio weighted according to the owner's age, tax bracket, and actual use case. That is the kind of taxable brokerage portfolio I would trust, not flashy, not fragile, not built for thumbnails, built for years. And that, in the end, is the whole point. A taxable brokerage account is one of the few places where your intelligence about money gets tested without many guardrails. If you pass that test, you do not just get a better account, you get a better investing mind that is worth far more than the next hot ETF ever will be. And there is one more thing I would add, because this is where a great many beginners quietly go wrong. They think taxable brokerage money must behave the same way at every age. It should not. A younger investor with decades ahead of him can tolerate more volatility, more growth tilt, and even a small aggressive sleeve because time is acting as shock absorber. A 45. Old with high earnings and hopes of early retirement has a very different use case. He needs tax awareness, usable access, and enough growth without turning the account into a pure momentum engine. A retiree or near retiree needs still something else: income quality, lower stress, lower volatility, and a portfolio that will not bait him into selling at exactly the wrong time. These are different jobs. Different jobs deserve different weights. I distrust universal percentages for that reason. What I respect instead is principle. If you understand the jobs, the percentages become much easier to reason through. If you do not understand the jobs, the prettiest pie chart in the world will not save you. That is why I would rather teach judgment than merely hand out symbols, because judgment is what keeps you from putting a bond ETF in taxable when it belongs in sheltered space. Judgment is what keeps you from chasing a 10% yield that turns into ugly tax drag. Judgment is what keeps you from owning international simply because diversification sounds noble. Judgment is what keeps you from mistaking a thematic ETF for a core holding. Judgment is what keeps you holding the boring winners while other people race after noise. And boring winners are how most real fortunes get built, not through cleverness theater. Through disciplined ownership of productive assets, tax awareness, patience, and enough self-control. Not to constantly interfere with the machine. That is the answer I trust. That is the kind of taxable brokerage portfolio I would build. And if someone wants a list badly enough, fine, I will give him one. But I want him to understand that the list is not the edge. The edge is knowing why each piece belongs there in the first place.